In telling the story, I'd like just to go back almost 16 odd years or so, which is the vintage of our very first fund. And we've ended up in transport almost by happen chance as opposed to by some divine strategy, to be honest. It's a type of asset which does tend to lead in jurisdictions where private sector are invited into the infrastructure space in evolving jurisdictions. It's invariably on a transport asset because they're easy to understand, they're easy to digest, and they're easy to communicate around. So as a result, in the early years, going back almost 15 years or so, we were involved in airports in Tanzania, rail projects in Cameroon, port concessions in Namibia. More recently, it's been very much toll road focused. We are currently the largest investor by a long shot in the South African toll road program. And that's been a consequence of being part of the Greenfields investments at the outset, 13 odd years ago, as well as providing liquidity for contractors when they look to exit these assets and continue to re-up or buy into these assets. Now, the reasons actually work for us from an investment perspective, and I must be a little bit careful I don't delve too heavily into the fundamentals of investments, but bear in mind we are equity investors, and as a result, our orientation is pursuing upside. And we pursue upside by exerting influence in a positive manner, either through shareholder influence or direct influence in the areas that we think we can make a difference. Now, with that mindset, the thing that infrastructure, or rather transport assets, do lend themselves to as an asset class, generically, is they are assets which do have a patronage characteristic to them. They have a throughput characteristic. So it's cars down a road, or trucks down a railway line, or aircraft landing. And that throughput characteristic, which grows the GDP growth and grows over time, does create the upside opportunities. So patronage is an important characteristic from an investment perspective of transport assets. The other thing is they tend to be monopolistic. Invariably, there can only be one railway line that Paul's talking about, or one regional national airport. And investing in a monopolistic asset gives a preferred positioning from a competitive perspective and gives it preferred cash flows, and that makes good sense. The other thing from a funds manager's perspective, these are capital intensive assets, so you have to spend a lot of money up front to build them. Getting a lot of money to work that delivers a moderate return is what fund managers seek to do. They'd always like to do a larger deal than a smaller deal. So transport assets that have big numbers attached to them do make sense. Having got that, nevertheless, so once the asset's in the ground, coming back to my earlier point of where can you actually exert influence, it's areas like optimizing operations. It's leveraging in that technical expertise of how railways are efficiently run. What is it that actually attracts people to toll roads, and what is it that drives your non-aeronautical revenues, for instance? Improving revenue lines, very important part of the investment thesis, but so too is continuously optimizing your capital structure. Because they tend to be capital intensive, quite a fair proportion of the revenue line does actually go to financing. Anything up to 30 to 50% tops will be consumed in operating the asset, but ordinarily something in the order of 50 to 70% of the free cash will go to financing. And it's really three people who get financed. It's the lenders, it's the equity, and it's the taxman. And continuously over the life of the asset, one spends a lot of time optimizing the structure of those assets, which transport assets do lend themselves to. Probably the final point, well, indeed the final point, but an important one, is as one operates in Africa, you hear consistently the same concerns from the investors. What about political risk? What about currency risk? What about liquidity? In respect to the former one, political risk, transport assets have a unique aspect to them that you can diverse your credit amongst the users. For instance, we have a toll road in Lagos that passages 80,000 vehicles a day. So the choice that we have is either to take single party credit risk against the Lagos state governor or the federal government of Nigeria, or to put our credit risk in 80,000 people a day. In this instance, we've gone on the latter, and as economies grow, as expendable income grows through GDP growth, the credit risk does disperse into the population, into the users, and it creates a bit of a virtuous cycle. That good infrastructure, delivering good services, strengthens economies, grows GDP, builds expendable capital, and so that in itself funds sustainable transport. So from a thematic perspective, investing in transport and transportation assets makes great sense to us. It's not the only one we do. We also do power and many other types of assets. But transport assets do have a characteristic to them for those jurisdictions that are looking to entice the private sector into their jurisdictions. They will be well advised to consider transport assets to be the first one that they actually implement.
Doing business in Africa. You can't afford to be without Africa Investor.